The Hershey Company, stock ticker HSY, is down 16.9% since January 2023. It is currently trading close to its 52-week low at $187 per share, which is over 32% from its all-time high in May 2023. So, is this a good buying opportunity for the Chocolate King, or will the stock continue to fall in 2024? Today, we'll be taking a deep dive into Hershey, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, and I will also share with you my strategy and what I've been doing with Hershey in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Founded in 1894, Hershey has evolved into one of the world's largest and most beloved confectionery companies. It owns a diverse portfolio of iconic chocolate brands like Hershey's, Kit Kat, and Reese's, famous candy brands like Twizzlers and Jolly Rancher, as well as its own line of salty snacks and protein bars. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Hershey has slightly lagged the S&P, increasing 76% since January 2019, while the S&P 500 increased 80%. However, if we compare the return as of May 2023, which is just before the start of the sharp decline of the Hershey stock, we see that Hershey was actually outperforming the index by almost 100 percentage points. That is over double the return of the S&P in 4.5 years. Now, when comparing Hershey's performance with its competitors, Mondelez, Nestle, General Mills, and Danone, over the last 5 years, we see that despite the recent decline, Hershey still has the best performance, closely followed by Mondelez with a 73% return. General Mills and Nestle increased 55 and 37% respectively, while Danone was the only company that actually saw a decline in their share price since 2019. At the time of filming this video, Hershey is a large cap company with a market cap of $38.4 billion. It is trading at a price to earnings ratio of 22.5 and has a nice dividend yield of 2.54%. Before looking into the safety of the dividend, let's first see how Hershey has been performing financially for the past few years. Looking at Hershey's revenues since 2018, we can see that it grew from 7.8 to 11.2 billion in the trailing 12 months. That's a CAGR, or an average annual growth rate, of 9.4%. Similarly, we can see that net income increased from 1.2 billion to 1.9 billion, which is a healthy CAGR of 12.8%. Generally, we want to see at least 3 to 5% for mature and well-established companies, so above 9% growth rates for top and bottom lines are very good to see. As for the balance sheet, we see that the cash balance in 2018 was 588 million, and it slightly decreased to 471 million in the trailing 12 months. However, we do see that current assets, which also includes the cash balance, increased from 2.2 billion to 3.2 billion, which is an annual growth rate of 9.2%. Net debt, which is sum of short and long-term debt minus cash and cash equivalents, increased from 3.9 billion to 4.8. That's an average annual increase of 5.3%. So, although net debt is increasing, it is increasing at a slower rate when compared to Hershey's current assets, revenue, and income. So I personally don't see anything to worry about here. In terms of the dividend, Hershey has a dividend safety score of 93 out of 100, which gives it a very safe rating and means that a dividend cut is highly unlikely. It has an outstanding streak of paying dividends every single year for 93 years without a reduction, and has been increasing the dividend for the past 13 years. The dividend has been increasing on average 9% in the last 5 years and 10% in the last 20 years. With the latest increase coming at 15% in July 2023. As we see here, Hershey's dividend yield of 2.54% is higher than its 5-year average of 2.03%, which could indicate undervaluation. However, we should not look at any metric in isolation, and we will make conclusions by the end of the video. Similarly, Hershey's forward PE ratio also indicates undervaluation, with a forward PE ratio of 19.3 versus its 5-year average of 24.3. Hershey's earnings payout ratio, which is the percentage of earnings payout as a dividend, is 49%. The threshold of acceptable payout ratios slightly differs depending on the industry, but we generally want it to be less than 60% as it gives the company some space to continue increasing the dividend in the future. One important thing to note is that earnings are subject to accounting manipulation, so I personally prefer to look at the free cash flow payout ratio instead. For those who don't know, free cash flow is the amount of cash left for a company after it pays out all its bills, reinvests in the business, and so on. So the free cash flow payout ratio is the percentage of remaining cash on hand that is paid out as a dividend. Again, anything under 60% is our preference, and as we can see here, Hershey's free cash flow payout ratio is currently 54% and expected to stay at that level in 2024. So it's below our preferred threshold. Moving on, we can see that earnings per share and free cash flow per share have been steadily increasing since 2013. The free cash flow has had a few dips, but the general trend is still upwards in the right direction, which is good to see. Shares outstanding has decreased from 227 million shares in 2013 to 206 million shares today, meaning that Hershey has been buying back its own shares. We generally like to see declining shares as it signifies that our ownership stake of the company is getting bigger and that company's earnings are being distributed on less and less shares. So technically we're getting a bigger piece of the pie. And over here we see a graphical representation of the increase in revenue, which we discussed earlier, growing from $7.2 billion in 2013 to $11.2 billion in 2023. Now, coming to Hershey's return on equity and return on invested capital, return on equity, or ROE, measures a company's ability to generate profits for each dollar invested in the firm. Higher ROEs usually signify a company's moat, and as we can see here, Hershey's ROE is consistently over 50%, signifying a very strong moat in its industry. On the other hand, return on invested capital, or ROIC, measures the company's ability to effectively allocate and reinvest capital and generate value, whether equity or debt. Many investors use ROIC as a measure of company's management. And Hershey's ROIC, as we can see here, has been consistently over 25% since 2013. Moving on to Hershey's operating and cash flow margin, we see that Hershey is able to consistently maintain a healthy operating margin in the low 20s. The same can be said for the free cash flow margin, always over the 7% threshold that we like for consumer staples, except for 2014, where it slightly dipped to 6%. As for net debt to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we usually like to see it under 4 for consumer staples, and it's currently well under that threshold at 1.49. This basically means that it would only take Hershey a year and a half to pay all the company's debt with net cash on hand. We see similar patterns for net debt to capital and interest coverage, with Hershey comfortably surpassing the preferred threshold for consumer staples, indicating a healthy balance sheet and a safe dividend. One last thing to check before moving on to the valuation models is how did Hershey perform in the last recession of 07-08, especially with the ongoing speculations of a potential recession looming in 2024. As we can see here, Hershey's dividend was maintained during the recession, basically meaning that there were no dividend cuts. Its sales dipped slightly by 0.1%, which is still above average growth as most companies experienced a significant decline in sales during the recession. And finally, the stock declined by 30%, which again beat the S&P 500, which declined by 55%. So if someone's looking for a relatively recession-resistant stock, maybe Hershey's worth a look. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far and are getting value, please smash the like button and subscribe to the channel to ensure that you're notified of similar future videos as they drop. Also, please let me know in the comments if there are any specific companies that you would like me to analyze in the future. Our first model is the famous discounted free cash flow model, where we estimate Hershey's intrinsic value based on the present value of their estimated future cash flows. Here is the free cash flow that Hershey generated over the last 10 years, which grew at an average of 13.52% per year. Based on analyst estimates, we use a conservative 9% growth rate to project future free cash flows, and using an 8% discount rate, which is also our desired rate of return, we get the present value of all future free cash flows as well as our terminal value. Adding them together, plus cash and cash equivalents, minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total number of shares outstanding, we get a fair value of $243 per share, which is above the current price of the stock. The second method is the multiples valuation model, where we obtain Hershey's fair value based on the multiples of its current competitors and companies within the same sector. We do so by getting the current PE multiples, calculating the average PE, and multiplying it by Hershey's current earnings per share to get our fair value, which is $219 per share. The third model is the dividend discount model, where we estimate Hershey's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. We see here Hershey's total dividend paid per share in the last 5 years, which grew on average 10.13% per year. Now, given Hershey's financial performance, it's possible that they continue to increase the dividend at this rate. However, I chose to be a little bit more conservative and go with a mere 6% growth rate for future dividends, especially considering that we might face a recession in those years. Now, discount that at 8%, we get a fair value of $236 per share, again higher than Hershey's current price. The last model that we'll review today is the historical multiples valuation model, where we estimate Hershey's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal PEs. As you can see here, the Hershey stock was trading at an average 26.1 PE during the last 5 years, 24.25 in the last 10 years, and 22.78 in the last 20 years. We calculate their average and multiply by Hershey's current earnings per share to get our fair value of $226 per share. Let me know in the comments if you would like me to make a separate video about this model and how to obtain these historical multiple statistics. Finally, in order to obtain our intrinsic value and acceptable buy price, we take the average of the 4 fair value estimates generated by our models. The intrinsic value we get is $231 per share, which is much higher than the stock's current price, but lower than its 52-week high. Without a margin of safety, the stock would be a buy at the current prices. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $208. Always consider the current and future macroeconomic conditions and the risks associated with the industry or the sector that your company is in order to get a reasonable margin of safety. With the current headwinds of the rising cocoa prices and potential recession looming, you might want to consider a higher margin of safety. For a 15% margin of safety, the acceptable buy price would be $197. If you're looking at a 20% margin of safety, your buy price would be $185, which is slightly lower than the current price, but still above its recent 52-week low. Finally, in terms of Wall Street's expectations for Hershey stock, they're forecasting it to trade at $218 per share in 12 months, which is a bit lower than our estimated intrinsic value, but higher than the current price with strong potential upside. Personally, I do like a 15 to 20% margin of safety for Hershey stock. I've started a position and will continue to add to it at these levels. I do believe that the company has a wide moat, a strong balance sheet, and I do like management's dedication to dividend growth and their commitment to their shareholders. In terms of the risks associated with the rising cocoa prices, yes, it might have some downside implications to the stock price and some margin contractions in the short term, but in the long term, say 10 plus years, which is my time horizon, I think Hershey has enough pricing power to adapt and overcome such headwinds. Let me know in the comments below your thoughts about the stock. Do you agree with Wall Street's price target for Hershey and our intrinsic value? Do you believe Hershey to be a strong buy at these levels? Or do you believe the downside risks outweigh the potential upside return? With that being said, don't forget to like and subscribe, and I will see you in the next video.